The goal of investing is to make your money work for you so that you no longer have to work for money. And the stock market is one of the greatest creators of wealth, but only 56% of people are investing in the stock market. Why are 44% of the people not investing in one of the greatest ways to grow their own wealth? Well, a big misconception is that the stock market is for the wealthy and people who have a lot of money. But this couldn't be further from the truth. Today, there are more opportunities and more ways to invest in the stock market than ever before. Hi, my name's Clark, and I'm here to help you learn the basics of investing and get you on your way to building wealth and becoming financially free. The first thing we need to learn is about compound interest and how powerful it can be. Compound interest is the interest you earn on interest. To make things simple, let's say you have $100 invested at 7% annual growth. After 1 year, you're going to have $107. Then, after year 2, you're going to have $114.49. So you can see, on the second year, you gained 49 more cents than you did the first year. I like to compare this to a snowball rolling down a hill. At first, it's a very small snowball and gets just a little bit of snow each rotation, but as it gets bigger and bigger, it's gaining more snow each rotation compared to when it first started rolling down the hill. This is exactly how compound interest works. Every year, you're going to be gaining more and more interest on your money. Let's take a look at an example over a long period of time. Let's say 30 years. We're going to be investing $6,000 a year, which is how much you can invest in a Roth every single year. And this money is going to grow at 7% per year, which is the average for the stock market over the last 50 years, adjusted for inflation. If we adjust for inflation, this allows us to see what the buying power of our money has compared to today. At the end of this 30-year period, you will have invested $180,000 of your own money, but your account will have grown to just over $567,000. That means just over $386,000 was from growth alone. Let's say instead of 30 years, we can actually do this for 40 years. That means we will have invested $240,000 of our own money, but the account has now grown to $1.2 million, which means the account has grown over $980,000, all from compound interest alone. You can see, once you get the ball rolling, it's going to do all the work for you, and you're going to be earning money all times of the day, even while you're sleeping. The earlier you can start investing, the more time compound interest has to work, and the more your money will grow. So this is why you should start investing as early as possible, even if it's only small amounts. Next up, we need to know what a brokerage is. A brokerage is a person or a firm who arranges transactions between buyers and sellers. A brokerage company is where we can open an account to have access to buy and sell stocks. A few common brokerage companies are Fidelity, Vanguard, and Charles Schwab. Within these brokerage accounts, you can open many different sub-accounts, like a 401k, IRA, Roth IRA, HSA, or just a normal taxable account. And within each of these accounts is where you can invest and buy stocks and index funds. If you would like more information on these accounts and what order I recommend investing in them, go ahead and check out my video, How to Invest for Retirement, linked in the description below. If you've never invested in the stock market, getting started can be the scariest part. And I remember my first few $1,000s I invested, I spent hours and hours looking at funds, trying to make sure I didn't pick the wrong thing. But in reality, the sooner you can get in, the better. The more time you spend in the market, the better chance you have at coming out ahead in the long run. There are multiple ways you can invest in the market today. These include mutual funds, index funds, ETFs, and stocks. Mutual funds are actively managed basket of stocks that are trying to beat the market. Since mutual funds are actively managed, they usually have higher expense ratios. The expense ratio is an annual fee expressed as a percentage of your overall investment. If a fund has an expense ratio of 0.5%, then for every $1,000 you have invested, you'll pay $5 a year in fees. An index fund is a passively managed fund that is just trying to match the market. And because this is passively managed, they have much lower expense ratios. So as you can see, a mutual fund is actively managed, trying to beat the market, while an index fund is passively managed and just trying to match the market. Both of these funds can only be bought or sold once per day. An ETF is very similar to mutual funds and index funds, where it's a basket of stocks trying to match the market. But the one difference with the ETF is you can buy and sell this at any time of the day. This definitely has an advantage if you're an active trader and trying to take advantage of the ups and downs of the market. Lastly, you can invest in individual stocks. With stocks, you will not be paying an expense ratio. You'll only pay a trading fee sometimes, $3 to $7 on most brokerage accounts, but there are lots of brokerage accounts that offer commission-free trading. If you're just starting out investing, it's a great idea to invest in an ETF or index fund that follows the S&P 500 or the total stock market. VOO is Vanguard's S&P 500 fund, and VTI is Vanguard's total stock market fund. The other brokerages will offer similar funds that follow the same indexes. When you purchase one of these funds, you'll have exposure to hundreds and even thousands of companies. These funds also have very low expense ratios. VOO has an expense ratio of 0.03%, which means for every $1,000 you have invested, you'll only owe 30 cents every year. Being diversified is a great way to hedge your risk against a single company going under. If you were to purchase individual stocks, you need significantly more money to be diversified. Some stocks, like Google, can be in the thousands of dollars, whereas you can invest in VOO, just put $1,000 in, and a small percentage of that will be invested in Google, along with other top tech companies. The majority of my net worth is in index funds or ETFs. I like to do this because it helps me stay diversified, and I also don't have to spend a ton of time researching different companies. If you take a look at most actively managed funds, you'll see that 90% fail to beat the market over a 15-year period. If they can't beat the market, I don't think I can either. If you invest in the market, just remember there's going to be ups, there's going to be downs. There will be times when your money does go down. But remember, if you take a look at the market over a 20+ year period, the market has always come out ahead. Now that you know the basics, we need to figure out what kind of investor you are. Ask yourself these 3 questions. What are your goals and timeline? What kind of risk tolerance do you have? And how involved do you want to be? Knowing these can help you determine where and how you invest your money. The longer your timeline, the more risks you can take. And depending on how involved you want to be can determine if you want to research and buy individual stocks or if you just want to passively invest in index funds. With all that said, I hope I've given you enough information to get you started on your investment journey to building wealth. If you had a good time, do me a big favor, hit the like and subscribe button. I hope you have a great day, and I'll see you next time.